Our next guest tells us it's been more than 100 trading days since the S&P 500 experienced a pullback of 2% or more from a closing high. And since the early 1950s, that's only happened 7 other times. And 6 months later, the S&P was higher every time with a median gain of about 8%. Here with some more content, Paul Hickey, a co-founder of Bespoke Investment Group. It seems like a kind of an indication of momentum that's hard to, it doesn't dissipate immediately.
Yeah, good morning, Joe. So I think the point of highlighting a metric like that, as well as several others we could cite in that or similar respect, is telling us what type of market we're in. And these types of patterns typically occur in bull markets, and bull markets are by definition periods of above average return. So if you want to get in front of those animal spirits and try and bet against the market, you're really going against the grain. And be my guest if you want to do that, but it's a risky proposition.
Seems like a lot of times a little bit of a pullback, builds up some skepticism and helps the market advance. I mean, we haven't had any sell-off of any kind. The VIX is low. There's no volatility. It's just been a slow, steady rise. What do you attribute it to, Paul?
Well, so I mean, I think we constantly hear about how the Fed, the pricing of rate cuts is going further and further out, and how is the market rallying in the face of that? Last week, Fed meeting, put the nail in the coffin on a May rate cut, and the market had its best week of the year. So you got to take a step back and think to yourself, okay, what is this market rallying on? Because it's certainly not rate cuts, because in January, we were pricing in 7 rate cuts. Now we're pricing in 3 rate cuts, and the market has done nothing but go up steadily since then. So what you have to think about is we're in a global bull market here. We're seeing Japan hit record highs. We're seeing Europe hit record highs. And economic growth here in the U.S. is stable. And even inflation, which is higher than the Fed's target, appears to be stable. And in that kind of environment, stocks can rally even if you have slightly higher than expected inflation or higher than preferred inflation. The Fed is, though, confirmed on the sidelines. And, just be careful what you wish for. Last week, we had the best week of the year when the Fed pushed out rate cuts further. So when that rate cut does come, they cut rates for a reason, as we've talked about in the past, and they usually don't cut rates because things are going great.
Paul, have multiples changed at all? What do you have where do you have the multiple? And is this advance all been growth in the bottom line of companies?
We have seen multiple expansion. We've seen about, we've seen, the S&P is trading, depending on what metric you're looking at, but about 21 times earnings, which isn't cheap by any stretch of the imagination. But it comes back to the point again that we're in an environment, bull markets, you tend to see valuations expand. And there's been a lot of, we talked about last time how this rally, if you break out the performance of stocks during this rally, it's all most of it's based on AI and prospects for AI. Companies that have any exposure to AI or stand to benefit in any way from AI have rallied. And it's no surprise that the bull market started within a month of when ChatGPT was announced back in late 2022.
And you think that's not just a coincidence?
No, I don't think it's a coincidence. And I think over time, you're going to see, we have concerns over inflation. I think, automation and not just, generative AI, but automation in general is going to have, if you thought the internet was, a deflationary force on the economy, I think AI and automation is only going to be, multiples greater in terms of, keeping inflation in check. And, we're dealing with above average inflation now, but the metrics we see don't point to another wave higher in inflation like we saw in 2021 and 2022.
So do you think we do need to see some worry about the economy to get the rate cuts? So you think that will happen later in the year?
Well, so I mean, well, think about this. The Fed is one of the most apolitical institutions we have right now. And if you look back historically, again, be careful what you wish for. The only time the Fed cut rates after May in an election year was in 2008. That was a 100 basis point oh, the sun's coming in the window now here, but it was a 100 basis point cut when the economy was falling apart. So we're starting to lose that window of when the Fed could comfortably come in here and cut rates, and that would be not seen by a certain side as being a political move. If you have rate cuts, it's going to be seen as political coming right up into an election.
Yeah. All right, so they're apolitical, but then again, they're human. I mean, is that your point?
But what we see now is looking at the data. Do you really necessarily need a rate cut at this point? I don't think the market's telling you that it doesn't necessarily need a rate cut at this point. The economy is holding in there, and inflation, it's higher than the Fed's target. It's coming. We're not seeing like real signs of a fall off in economic data here. So I think the one key to watch going forward will be the upcoming earnings season and how that comes. If there's one thing we would be concerned about in the short term, it would be the earnings results, because last week's results came in and they were pretty mediocre in terms of results and the stock price reaction. So that's the one thing we're watching here, but that's a vacuum that's not going to be resolved for another 2 weeks when their companies start reporting.